There's one catalyst in the crypto market which could send prices even higher this year. Amongst so much uncertainty, FUD, and doubt in the markets, we're looking towards that golden globe of hope that could potentially send crypto prices to higher levels. And I have one today that I want to share with you and explain and go through the statistics and the data to suggest why this could be a profitable trade this year. Let's get straight into the show. Now, over the past day, we have had a push up in the altcoins. It's nice to see some relief because Bitcoin did have 9 consecutive weeks of downwards movement. So it's good that we are finally opening a green candle. Now, a lot of these gains were slightly short-lived as we did see the pullback take place. However, we're starting to get a little bit of momentum in the markets at the moment. Now, I want to look at the Bitcoin dominance because this is really what's driving the market. And we can see that the Bitcoin dominance had a nice rally off this trend line here. We broke through resistance and we've had a nice bounce, which has been a roughly 6% gains to the upside in terms of the dominance. So whenever we see dominance rising like this is positive for the market because when dominance rises in tandem with altcoins, that suggests that there is liquidity flowing back into the market. And when dominance is rising versus altcoins rising, that typically suggests that there is room for altcoins to run. So it's always good when we get these rises in the alts alongside dominance because it does open up a little bit of room to run, which is a major, major positive. Now, this Solana trade that Sheldon did on the show yesterday, I know a lot of you asking about it. I personally didn't get my entry on that either because it was late in Australia and I know a lot of our levels weren't quite hit. But I think it really just highlights, how accurate Sheldon has been with the framework that he's setting. However, maybe we need to look for opportunities across the board as well. So although the Solana trade was great, there were also other great trades that Sheldon gave you the framework at the time. I think DOT and AVAX behave similarly. So when we do see these swings in these altcoins, we are going to see it happen across, a lot of the market and not just Solana. So that's, one interesting perspective to take in the future if you want to have a look at getting access to Sheldon's mind, access to what he's thinking, and then applying it to other altcoins as well. It's certainly going to be something that I start doing as well as my own trades. But yeah, this guy says Australian no entry club. And yeah, I didn't get my entry either because, it was like 2 a.m. I needed to sleep, had a show today. So I decided I'd just leave it for the night. But yeah, a lot of you didn't get the entries, but that's okay. We're going to get them next time. And I mean, the logic was spot on and it was pretty accurate. But I'm looking at the Ethereum price right now, and this is where things get really interesting because Ethereum has really been the major leader of these altcoins historically. We know that when liquidity comes back into these alts, typically it'll flow into the major altcoins like Ethereum first. So charting Ethereum is like getting an ultimate indicator on the health and the growth of the altcoin market in general. Ethereum is still the largest ecosystem in terms of DeFi. It's still the largest ecosystem in terms of weighted transactions against its gas fees. So it really is, the quintessential chart to track when we're looking at how altcoins might perform. And Ethereum has had a nice response alongside a lot of these other altcoins. It was up around 7% over the last couple of weeks, and it's showing signs that it is gravitating towards this trend line here. If we did get a breakout of trend, there's potentially some nice upside for Ethereum. But this is the chart that I'm looking at and I'm tracking right now. And the reason I'm tracking it is because Ethereum is home to the biggest catalyst in crypto in 2022. This catalyst is the Ethereum Merge, and it does have a lot of potential to see potentially much higher Ethereum prices in the future. So what I want to do is I want to break down the math, break down the statistics as to how the merge will affect A, Ethereum staking rewards, B, Ethereum's price, and have a look at some of the ramifications it can have on the market as a whole. And then at the end of the show, I'm going to be going through some Ethereum staking strategies, giving you a staking update. I'm going to give you 3 strategies for staking your Ethereum today: a centralized option, a decentralized option, and then a slightly riskier option for Ethereum staking as well. So I'm going to run through all that, the Ethereum merge, and what it means for crypto. It's going to be a massive show because this is honestly the biggest catalyst of 2022. And in order to understand where the DeFi space is going in the future, I think a great place to start is starting with Ethereum. So, of course, just before we get started, if you do want to take part in these trades, Sheldon shows have been popping off at the moment, and I've been getting involved with some trades as well. Then there's a link in the description to sign up for a BYBIT account. Remember, you could have your portfolio doubled live on the show if you sign up. And there's also sign-up bonuses as well for you guys to get involved. So if you do want to take part in some of these trades, there's a link in the description. Sign up for BYBIT and get going with it. But this Ethereum case right now is quite strong. And Root2Fi did a tweet, and he said the bear case for crypto right now, everything. The bull case for crypto right now, the Ethereum merge. And I would say in some ways this is true. Right now, we have a very bearish macro landscape. Overall, I am largely bearish about cryptocurrency over the next 6 months. However, ETH Merge is the shining light at the end of the tunnel right now. It is the event that's going to be happening later in the year, and I'll have a look at some dates in a second, that could potentially have a great response price-wise and also set up DeFi for a little bit of a rally towards the end of the year. So I'm going to look at the merge and kind of help you guys explain and understand how this could affect the tokenomics, and why this could be a positive in the future. So the first thing to understand is what the Ethereum merge actually is and what it's aiming to achieve. So if you guys don't know, Ethereum operates on a proof of work consensus, which means Ethereum needs to be mined through miners, similar to Bitcoin. Transactions actually need to be verified by miners in order to mint new Ethereum. So the issue with this is that although proof of work is very secure, and to this date it's probably the most secure consensus mechanism, we know that it doesn't really scale. And we know that it can cause very high gas fees as the difficulty increases as demand for Ethereum mining increases. So we have seen its lack of scaling ability compared to these other L1s. If you look at like the gas fees across AVAX, across Phantom, across Solana, they're all sub $1. And then you go to Ethereum and you get potentially up to $100 gas fees sometimes. Now, the Ethereum gas has alleviated a little bit around the $10 to $20 region at the moment. However, it's still way too high. For the average retail participant, it's going to be far too high to pay a gas fee like that. So long term, for Ethereum to actually gain mass user adoption, it needs to decrease its gas fees while being able to handle more transactions so it can scale and so it can onboard the mass amount of users that we know crypto is going to be onboarding over the next decade or so. So for Ethereum to succeed, it needs a scaling solution. And the merge is the ultimate solution that they've been working on for the last couple of years. So it's basically a transition from the proof of work consensus to the proof of stake consensus. And it's the implementation of shard chains in a couple of years' time, which are going to help Ethereum scale. And it's going to help that transaction volume translate into lower gas fees and also higher rewards for stakers. So in Q2 2022, at the moment, in addition to the Ethereum mainnet, there's a proof of stake Ethereum network called the Beacon Chain, which went live last year, but that's going to start being implemented so you can stake Ethereum on the Beacon Chain and be granted validator privileges. So when Ethereum finally does transition to proof of stake, the merge will see the Ethereum mainnet become a shard of the Beacon Chain. So this will mean the network consensus mechanism changes and the implementation of the shard chain will offload data storage and access. It'll reduce congestion of the network. It'll reduce transaction fees and help it scale. Now, we all know sharding is a wonderful way of scaling. We've seen it implemented throughout multiple chains at the moment, most notably Near Protocol, which has sharding today. And it's been a major success in terms of providing low gas fees and handling a lot of transaction volume. Now, Ethereum needs sharding to succeed. So the merge is paving the way for sharding in 2023. And this will help support shard chains, which is going to be much better overall for the Ethereum network. Now, I think the Ethereum merge is going to have not only great ramifications on the usability of Ethereum, but also on the staking rewards of Ethereum, because it does two things. The first thing it does is it's going to increase the rewards for validators significantly. So in order to verify transactions on the network, Ethereum now needs to be staked inside the validator nodes, which will enable you to earn yield if you're staking, and it will also help secure the network. But the other thing is that Ethereum, essentially due to its decreased issuance and its increased ETH burn, this combines to mean that the Ethereum price is set up better in terms of tokenomics. Because when you are getting decreased issuance, this means there's less Ethereum coming onto the market. So in theory, the price of Ethereum should rise as a result of this. So there's been some very interesting data which has come to fruition here that I want to look at to understand the economic model of the Ethereum merge, because the important thing at the end of the day is looking at how Ethereum's price could potentially be impacted by the merge, and why this could be a catalyst, and not just saying it will be a catalyst. So there's a great thread here that DeFi Surfer did, and he goes on to say that The too long didn't read of the Ethereum merge are that fees are the most important driver of the model post-merge. Obviously, fee generation we're seeing is now more important than ever as a lot of emissions tend to dry up. So the more fees that chains can generate, the more successful they're going to be long-term. So he estimates a 9% staking return at merge, trending to 5% longer term. So it's going to taper off in terms of its rewards. And because ETH staking rewards are low, ETH can be deflationary even with low levels of activity. So the economics, like I alluded to before, post-merge will be driven by two major factors. A, the ETH token issuance to validators, so the stakers, and B, fees generated by Ethereum's network. Obviously, the more transaction volume the chain can do, the more fees it generates and the more rewards will be paid out to stakers. So there are some good statistics here that kind of give us an idea as to how the issuance will affect the Ethereum price moving forward. So DeFi Surfer says, I don't think any of us are prepared for what's going to happen in the next few months after the merge. I estimate Ethereum's inflation rate will drop from 3.3% to minus 0.7% at the merge, which means Ethereum becomes deflationary. So right now, every single year, every single month, there is more Ethereum being put onto the market. It's an inflationary token in essence. But post-merge, due to the models that we now have access to, they're suggesting that Ethereum now becomes deflationary. So Ethereum supply will now gradually reduce over time. And we know that deflationary assets typically behave more positively in terms of price action. So this is very interesting. This is a graph of the Ethereum inflation rate before the merge, which is 3.3%, and the Ethereum inflation rate after the merge, which is estimated to be around 0.7%, which minus 0.7%, which is a positive in return for Ethereum. So after the merge, 90% of the daily emissions will be cut. So right now, there's 12,000 Ethereum a day being put onto the market. This will now drop to 1,280 ETH. And yearly inflation will go down to, we've seen a couple varying estimates, but the general consensus is between minus 1% and 0.5 to 0.6%. And rewards from proof of stake validators will go up from 4.5% to 10 to 15%. So right now, if you want to earn yield on Ethereum, if you want to stake your Ethereum in a validator node, you'll be getting around 4%. You can do so through Lido if you want to keep your ETH liquid. I'm going to be touching on a couple interesting things to do with Lido in a minute. You can stake it through the validator nodes, but you'll only be earning 4%. So I think the real draw card here for Ethereum is that if it can offer, this 10% plus reward, it's going to incentivize a lot more people to lock up their Ethereum. And we all know that the more of a token that's locked up, the better that is in terms of price action. Reducing the circulating supply in tandem with the decreasing issuance will be a positive overall for the Ethereum price. If the merge succeeds, that is. Now, obviously, there are risks with the merge. The merge isn't perfect. We don't necessarily know how it's going to look in the future. There's been, many people that have come out and kind of said that, proof of work is historically a more proven consensus. And I would tend to agree with that, and that the proof of stake model presents significant threats. Now, obviously, there is a lot of stake, no pun intended, for Ethereum going forward, because there's a lot at stake considering that this is a major change. We've never seen an overhaul to the blockchain like this in its history. So, it does run the risk of something going wrong, and that could potentially be negative. But I'm bullish that this will be a positive for the network. And I'm confident that the years of work that they've put into the merge will result in some positive results coming to fruition. So the energy consumption of the network is estimated to drop by 99.95%, which will be tiny even compared to traditional payment rails like Visa, MasterCard, etc. And being less reliant on the grid, we all know this is obviously better for the environment, but it means it's much harder for state actors to censor the network, as hundreds of thousands of people will be able to run on proof of stake validators. And I think this is an interesting point, because it's very easy for countries to just shut down Bitcoin mining. We've seen it happen in China. We've seen some fears across Europe about certain countries shutting down Bitcoin mining facilities. The same thing could potentially happen to a proof of work network like Ethereum. So I think the transition from proof of stake does make it a little more secure in terms of, a state coming in and trying to gain the controlling interest, over that technology. Although it does come at a trade-off to security. We know proof of work is historically the more secure consensus, but it's nice to know that A, proof of stake is obviously better for the environment, and B, there's less a likelihood of government intervention in this sense. So I think this is potentially the best thread that was posted on the Ethereum yield and valuation post merge, and he posted this yesterday. So the TLDR is 10% yields are estimated post merge, and the estimated Ethereum price is 6K. Now you might be sitting back and thinking $6,000 Ethereum. This is kind of crazy. It's at what, 1,800 now. What, that's going to 3x. But he actually does a very interesting model, which is a cost model, which typical stock traders would use in order to work out the valuation of a stock. So he uses the discounted cost approach to work out the valuation, the fair value of Ethereum based on A, the fees it generates, and B, the staking rewards, the yield it generates to work out its fair valuation. So his DCF, discounted cash flow prediction for the Ethereum network is actually $6,100. With the PE expansion or monetary premium assigned, he thinks it could be much, much higher. So these scenarios, this model that I'm about to show you is based on the blockchain fees. So the fees that the Ethereum network can generate. And if we take the fees, which is in line with a typical discounted rate, so 10, 15, and 20% for different risk models, we can see that his estimate is conservatively $4,000 for Ethereum post-merge. The base model, the median model, is $6,000 post-merge, and then the aggressive model is close to $10,000. Now, we know that crypto is largely driven by speculation. We know that these markets are driven by retail mania hype. So, a lot of these discounted cash flow models, they don't necessarily translate as well to crypto as they would to a traditional stock market. However, it is important to treat our crypto like stocks at the same time. Look at PE ratios, look at DCF models to get a better idea of how we can actually value crypto, because if we're operating in isolation and just valuing cryptocurrency against other cryptocurrencies, we're kind of operating in this bubble. So I think it is good to step back and take a traditional approach to valuing crypto, albeit probably less effective in this space because the technology is so new. It's largely driven by the future valuation of a network effect and not necessarily, the current tangible metrics that we see. But a 6.1K Ethereum would obviously be a very bullish case for crypto. And you have to ask yourself the question, if the Ethereum merge does succeed and we do see these crazy returns from Ethereum, if it does 2 or 3x, then obviously that is great for the crypto space as a whole. Because, if Ethereum did hit $6,000, then there's now a lot of liquidity coming into the market. To move Ethereum's market cap, it would need, hundreds of, probably 100 billion plus of net inflows coming into Ethereum to actually pump it to those levels. So that amount of liquidity coming into the market, assuming that it isn't coming from other altcoins, which would tank the rest of the market, assuming there is now retail interest that builds up, institutional interest that builds up, this would mean that there would be a flow-on effect for the rest of the market. So this is why I'm saying that the Ethereum merge is probably the biggest catalyst for 2022, because it's potentially the only thing that can trigger, a mass event in terms of liquidity coming into the market. Because right now we're looking at only really a few catalysts which can push this market up in a bear market, given, this hawkish monetary policy, given the general bearish consumer sentiment. The Ethereum merge really is a shining light amongst all this. And, there's other bullish catalysts, like obviously some institutional adoption that's being rumored. Obviously you've got like the chance of a Bitcoin spot ETF in the US. Not sure whether that's going to happen. It seems unlikely given the amount of rejections. Eventually, I know it'll happen, but in the short term, those are some of the catalysts we're looking at. So the Ethereum merge does stand out. So what can you do to prepare for the merge? If it is going to be testing some of these levels in the future, I'm not saying it'll happen this year, but potentially next year or the following year, how can we set ourselves up for success in terms of benefiting from the Ethereum merge? Well, the obvious play here is to own Ethereum. I am bullish on Ethereum long term. However, in the short term, we are going to see volatility. We are still fighting, a macroeconomic headwind at the moment. We're still fighting raising interest rates. We're fighting QT, so quantitative tightening, which obviously from a macro perspective means that technically equity valuation should be coming down. So what I'm doing with my Ethereum is I'm taking the DCA approach. I'm trying to be pragmatic with continuing to accumulate Ethereum, because I don't know where the bottom's going to be. I don't know whether the bottom's going to be $1,000. or $500 or $1,500, or whether the bottom's now. We don't know that. So with a coin like Ethereum, which has a proven track record historically, I don't treat it like other altcoins. I'm not treating my Ethereum position like my Solana position, like my AVAX position, because Ethereum actually is battle tested, and Ethereum is, in my opinion, a genuine blue chip. So I treat that as a true DCA, which means I'm not really looking at swing trading ETH. I'm not really looking at taking crazy heavy profits at the top or crazy buys at the bottom. I'm continuously DCAing. So that would be my approach for Ethereum, considering that it is one of the only coins that's proven itself historically, and it's one of the only coins in the future, that we know for sure has that network effect, because we could see that the transactions have been extremely solid even amongst the high gas fees. It still managed to clock around 1 million transactions a day. When we look at the unique address chart, compared to many other chains, the Ethereum unique addresses are absolutely, exploding relative to other chains. It's done 66K today, 85K last week. Even at its peak during this bull market, it was doing like 120, 130K. That isn't a major drop off. So we are still seeing the growth of Ethereum in general. A lot of this growth would be coming off the back of its NFT sales. Obviously, it still is by far the biggest NFT marketplace by volume. We did see Solana start to recover a little bit in terms of the gap between Solana and Ethereum. But I mean, Ethereum's at a 10x over the last 24 hours to Solana. We're seeing like OK Bears and a lot of these other projects, gain, not OK Bears, Goblin Town gain a lot of popularity on Ethereum. And obviously that's resulted in, a large amount of sale volume. So the NFT volume is one thing that Ethereum has going for it, and it's a genuine blue chip. I mean, it does pose the question, once the merge goes through, if proof of stake genuinely succeeds in the short term, and there's not massive delays or whatnot, can Ethereum really start separating itself from these other L1s? Now, I still am a large proponent of a multi-chain future. I think that if we are going to get this mass adoption coming into the crypto space, then we're going to need L1 power. Ethereum won't be able to handle 10 to 20 million transactions a day, even with proof of stake, at least not for many years, until a proper sharding solution is implemented. So I do think that L1s still have massive potential, and that's why I continue to allocate. But if you're looking at, a safer bet, maybe in terms of risk reward in a bear market, then Ethereum is going to be one of those coins. And that's why I skew my DCAs heavily towards, Bitcoin. But right now, honestly, more so Ethereum, because, it still has that upside potential with the merge, doesn't have the crazy downside like a lot of those other alts. But it's interesting to kind of frame Ethereum's market cap against these other alts, because it does have that market cap of 224 billion. And then we look at some of these ETH killers, which are 14 billion, 20 billion, 48 billion, and we kind of see how the market likes to value these L1s, because a lot of these L1s are being branded as, Ethereum killers, potential protocols that can overtake Ethereum. So it's interesting that Ethereum, largely has a 10x to a 15x gap on these. The market is basically saying that the likelihood of Ethereum succeeding long term is a 10 to a 15x higher than these other L1s. And I would agree that's pretty close to fair value, and that's why I do like investing at Bitcoin in Ethereum at these levels, because you're seeing these other L1s, they're still largely speculative, they're still very risky, and that's why something like an Ethereum, why try and beat the Ethereum killer when you can invest in the killer itself, is kind of the logic being thrown around here. And I would agree with it to an extent. You are going to get the explosive gains in the L1s. If the merge succeeds, that's where a lot of liquidity is going to siphon off. So very large merit to holding L1s. But at the same time, during this bear market, ETH is kind of where I'm skewing my staking slightly, skewing my DCAing slightly. Guys, remember, if you're watching the video so far, I'm about to show you an amazing staking strategy. Smash a like button and hit the subscribe button to see future content from Crypto Banter. The channel is going through a bull market at the moment. We've got Sheldon's show absolutely killing it. Rand shows, as usual, are doing a great job of kind of painting the macroeconomic picture. We got Johnny's shows, which are fantastic on gaming, and then obviously my shows, which are more DeFi orientated. So make sure you're subscribed if you're not subscribed already, and smash the like button. I want to see them absolutely explode for these ETH staking strategies I'm about to show you. So it's all very well to say DCA ETH. It's all very well to say, accumulate ahead of the merge, accumulate over the next couple of years. But if you're just keeping these tokens sitting in your wallet dormant, you're not maximizing the full benefit of these tokens. We know how important staking becomes in a bear market because incomes is very hard to come across. It's much harder now to hit these 10x's. It's much harder to hit trades. We've seen trading is as great as it is for making some short-term profits. It's a difficult skill and there's a huge learning curve. So how can we kind of continue to tick over some passive income and continue to earn some yield on our tokens, during the bear market to continue to increase our Ethereum stack, our, stacks across these other altcoins? Well, the answer is DeFi and through staking, through farming. And Ethereum historically has had very low yields, but we have seen some interesting, an interesting shift here from some of these protocols, which is starting to incentivize some Ethereum pools over their counterparts because, they are taking notice that, a lot of investors just want to hold Ethereum right now. There's not this huge risk on appetite in the market to hold some of these other assets. So a lot of people are now gearing their staking towards Ethereum. So I want to go through some of the best staking strategies for Ethereum right now that I'm personally looking at so you guys can stake it because, there's no point in just holding it in your wallet. You may as well start earning some yield. Now, the first thing I wanted to do was highlight a little bit of a risk with staked Ethereum at the moment. You guys know one of the major way to stake Ethereum is through Lido and is through these staked ETH pools. So if you want to stake Ethereum, that's one great way to do it. And, I've been a major proponent of these staked liquid staking protocols because you can keep access to your tokens at the same time as getting the benefits from locking them up through staking. But there has been, a little bit of concerns highlighted recently, which I kind of wanted to touch on. And the first concern comes from Celsius, and that is that 27% of Celsius ETH is liquid, so the rest is either staked ETH or staked in ETH2, which means it's inaccessible for at least 1 year. There's been a lot of withdrawals. Obviously, a lot of people are withdrawing from this pool here, which means that Celsius is going to need to cover their position at some point. So the logic here is that if Celsius runs out of Ethereum, which the estimation is that'll happen in around 5 weeks, then it'll be impossible for Celsius to honor redemptions after that without realizing massive losses due to staked ETH's liquidity. So eventually they'll be forced to gate all redemptions, not looking good. So the logic here is that potentially, we could see a sell-off in staked ETH, which could result in staked ETH dropping even further below peg, which could potentially, let the degen scoop up cheaper staked ETH. So this is actually an interesting play for you guys that I wanted to highlight today, and something I'm looking at doing is the staked ETH play. So Kamikaze ETH says staked ETH will be fine to convert back to ETH in the long term and post-merge, so he still thinks staked ETH is going to hold up long term. The DPEG is only a problem for pre-merge, so the merge is estimated to be in around August, September. So pre-merge before then over the next few months, staked ETH holders who suddenly need liquidity, may be forced to sell, which would result in the staked ETH DPEG happening. So if staked ETH DPEGs to something crazy like 0.8, it's like a 20% discount on ETH if you don't mind holding. So this is the first play I wanted to show you guys. As an arbitrage play. So if we do see a bit of a liquidation event happen on staked ETH, obviously I'll keep you guys updated on the channel with if that occurs and if I'm getting involved. But I just wanted to, highlight this for you guys now so you're aware of it. If staked ETH does drop significantly below Ethereum, I'll probably be gearing my Ethereum DCAs towards staked ETH because long term, I have conviction that it'll regain peg and that, a liquidation event would be temporary. So right now, the strategies I'm about to show you don't involve staked Ethereum, just because I do think there is a risk in the short term of staked ETH potentially depegging slightly. Long term, however, I think this will regain peg, so that will create an arbitrage opportunity. But right now, I wouldn't be using the Lido strategy. So the strategies I'll be showing you, are separate from Lido right now, just because the staked Ethereum scenario has me a little bit concerned. So I'm trying to stay away a little bit from this, just in case it does drop below peg. Once again, that will create opportunities. So that's also a positive for long-term Ethereum bulls. I'm sure a lot of you guys are in that category as well. I'm in the category, I'm a large believer in Ethereum long term. That's why it's one of my biggest DCA positions. So when we look at UniSwap, there are some pools here that are interesting. So I'm not recommending this today. However, in the future, this staked ETH Ethereum pool on Uni is paying 17%, which is a great yield. Typically, I would have come on the show and told you guys that this is my play. But due to the staked ETH a little bit of the risk around that. I don't want to put you guys in a position where, you're risking a DPEG event. So I'm staying away from this right now, but this is a good pool for staked ETH Ethereum. And then the next one I want to show you is on StellaSwap. So obviously, the first thing you'll need to start generating some yield, I'm going to show you a 15% strategy on Ethereum now. 15% in this market is very, very good. And something on Ethereum, which is considered a blue chip, I certainly wouldn't turn my back on it. I know a lot of you guys hold Ethereum, so, why not earn some yield on Ethereum, right? So the first thing you'll need is obviously Ethereum. Obviously you've got BYBIT, you've got those exchanges that if you're holding Ethereum there, you can transfer to your MetaMask. If you don't, you can swap on 1inch. 1inch is one of the show sponsors, and it's also basically the cheapest DEX in all of crypto because it aggregates across multiple DEXs. So it'll take the best yields from Uni, PancakeSwap, Spooky Swap, etc., and give you the best yield. So you can swap for Ethereum here, pay a very, very low fee. I mean, Ethereum gas right now is quite low. It's like $10, and 1inch is only charging you 0.0059. ETH for this swap. So I would use 1inch if you're going to do a swap just because it's the cheapest. And I want you guys to get the best rates as well. And yeah, once you have your Ethereum in your MetaMask wallet, obviously you need to have it in your MetaMask to start with these strategies. We know MetaMask is EVM compatible, so you should have the Ethereum network there. Transfer it to your wallet, or if you're on 1inch, then obviously it'll already be connected to your wallet. Then you want to come across to Multichain. Because the strategy I'm going to be showing you now is on the Moonbeam network. So if you want to take part in this ETH strategy, it's on Moonbeam, on StellaSwap. Now, Moonbeam is obviously, one of the major L1s. It's EVM compatible in the Polkadot ecosystem. The benefit of this is that you can do it directly through your MetaMask wallet, which is obviously, a major positive because you're not necessarily running the risk of having to use other wallets, etc. You can just use a MetaMask wallet, and it's very, very simple. So the pool I'm looking at here is this ETH Multi and ETH MAD pool, which is paying 14%. Yesterday it was around 15%. It does seem to fluctuate a little bit, but this is one of the pools that I do like for Ethereum staking, because right now, yes, you can pair your Ethereum with other assets like USDC. You can pair it with many other assets, which is obviously a positive in this market because you can earn great yields. But right now, I'm just looking at some of the single staking options, some of the options that don't involve other projects, because I'm trying to steer clear of impermanent loss a little bit. So I'm mainly looking at the Ethereum pairs. So this will give you no impermanent loss, which is one of the major positives. So you'll need to get your Ethereum onto Moonbeam if you want to take part in this strategy. So on Multichain, you can simply, if your Ethereum's on Ethereum, maybe you have it wrapped on Phantom, Polygon, wherever it is, you want to select the primary network where your Ethereum is actually located, and then you want to select the Moonbeam mainnet and transfer your Ethereum across these chains. So if you put Ethereum in here, you can swap it from the Ethereum mainnet across to the Moonbeam mainnet, which is obviously necessary in order to take part in this strategy. Now, once your Ethereum is across on Moonbeam, you can go to StellaSwap, app.stellaswap.com/farm, and StellaSwap will open up a bunch of pools for you. So if you go into the Farms tab of StellaSwap, it's Earn, and then you click on Farm. You can search Ethereum in the search bar. Now, this will bring up a few pools. The pool that I'm looking at right now is the Stable AMM pool, which is the ETH Multi ETH MAD pool. So if you click on this, it will bring up a tab which says Add Liquidity to start staking. Now, if you click on Add Liquidity, it'll show you the Stable AMM, so the liquidity pair that you want to be creating, which is the dual ETH. So it's ETH.multi, ETH.MAD. Both are Ethereum tokens. They're just different versions of wrapped tokens. So both are the same value as Ethereum. They're just wrapped in a different way. So the way to add liquidity here is to click add under the add section under the pool. And then you obviously add your ETH, which is from Multichain, and ETH to MAD. Remember, when you do transfer Ethereum from Multichain, from Ethereum to Moonbeam, you're going to need this ETH.MAD. Now, in order to add ETH.MAD to your wallet, obviously you'll receive ETH Multi, not ETH.MAD. You'll need to swap it. So if you click swap, you can swap from ETH Multichain to ETH Nomad. So obviously, with every liquidity pool, you're going to need 50-50 in order to LP it. So you'll need 50% of your assets in ETH.multi, 50% of your assets in ETH.MAD, MAD. Now, if someone's asking, what about impermanent loss? There's no impermanent loss on this pool because both assets are Ethereum. Both are the exact same price, so they don't move against each other. So essentially, there's no impermanent loss on this pool, which is why I'm telling you guys about it in today's show, because right now I'm trying to steer clear of impermanent loss. So although you'll get a higher yield with an ETH USDC pool, you'll get a higher yield with like an ETH Bitcoin pool, etc. That's going to expose you to impermanent loss. So I'd rather go for a slightly lesser APR for a safer yield. So yeah, you want to be swapping 50% of your Ethereum here from ETH Multichain to ETH Nomad. So you have 50-50 tokens, so you can actually pair them evenly in the desired farm. So the desired farm here is obviously this ETH pool. If you want to stake, you just click add liquidity to start staking, and then you click on the stable AMM, which is obviously the LP. So the LP tokens that you want to be creating, you click add, and then you select your Ethereum multi, your Ethereum MAD here, and you add them together, and that will create LP tokens. So once you have LP tokens, and you've created the LP tokens, which are the ETH tokens, you can come back into the farm. And if you come back into the farm, you can stake said tokens under this wallet balance here. So it'll show you how many tokens you actually have, and it'll show you their dollar value. And then you simply select how many tokens you want to stake, and you can stake them in this pool here. And this will give you your 14% annualized return. Now, it's not a very high return, I know, but for Ethereum right now, it's better than going with the 4% staking options, in my opinion, just for the meantime, until this Ethereum merge is here. Obviously, once the merge is here, then we'll all be staking in the validators, and we'll be making, a lot of money on it. We'll be making 10 to 12% through the validators. So that'll be fantastic. But in the meantime, these DEXs are giving us decent options. So remember, since it is a DEX, you'll be getting rewarded in Stellar tokens and Moonbeam tokens. Now, these tokens are weighted, so the APR is based on the current value of these tokens. But obviously, it's up to you what you do with these tokens. If you really want to play it safe, what you do is you'd swap all your Moonbeam rewards back for Ethereum, and you would create more LP tokens, and you'd compound back into the base pool. So you'd swap every day you'd get your Moonbeam, your Stellar rewards, you'd swap them. And I wonder if Stellar swappable now. It is. You'd swap it back for Ethereum, and then you would obviously go through the steps that I previously ran you through to create an LP, which would enable you to, obviously compound your position. Now, if you compound your position, you essentially go from a 13.5% APR to a 16% APR. Now, a 16% APY, which is obviously taking into account the yearly compounding on these tokens, would mean you're earning more yield. But that means you're accumulating more Ethereum. So you'd only want to compound if your goal is to stack more Ethereum. If your goal is to earn passive income, so, dollars off your current existing Ethereum holdings, then you want to be taking these Stellar and Moonbeam rewards back into, let's say, USDC, because that's going to enable you to increase your stablecoin yield. Personally, I'm compounding because, my goal is to accumulate more Ethereum. I'm not too fussed on the prices I accumulate it for, whether I can get it at 1,800 or 1,000 or 1,500, it doesn't really mean much to me because I am such a long-term believer. When you have long-term conviction in a project like this, the prices are largely irrelevant. With these altcoins, they are relevant because you want to be taking heavier profits, swing trading them because, they're a lot riskier. They're not as proven as Ethereum. But for Ethereum, I would rather just DCA because long term, I'm such a believer in the protocol and its network effect that I'm happy to just compound here. Now, obviously, DeFi, in this market can be a little bit risky. We have seen, some StellaSwap's definitely not a rug pull, but we've seen some, exploitations to some other DEXs. Now, although I do like Moonbeam, you just have to be aware that, it always is a possibility that smart contract risk can occur and, potentially hacks can occur. So what would my solution be for this? It would be don't have all your assets in StellaSwap. It's great for farming a percentage. The percentage, you allocate is up to you and your personal risk tolerance, but I wouldn't be farming all of it because obviously, then you're exposing yourself to too much risk. So I'd look at some other staking options alongside StellaSwap in order to diversify a little bit across farms. So another option potentially that you guys might like is something on a centralized exchange. Now, I've just used Yield App as an example because that's going to offer some centralized rewards on your Ethereum, which is up to 7% PA, 12% on stablecoins. So something like this could work. You've also got Celsius, Nexo, and BlockFi, which are also 3 other potential candidates here. So just have a look across some of these centralized exchanges. I know Binance as well. Binance has, its rewards program where it incentivizes staking. So you can stake your Ethereum and yield that for 7%. This is KYC. So obviously, if that's a consideration for you, keep that in mind. And obviously you've got Celsius, Nexo, and some of these other centralized entities, which are going to be great places to stake. So I do recommend spreading it out a little bit. Don't have all your eggs in one basket in StellaSwap, although the yield's great. Maybe spread it out across a couple options. And if one of those is centralized, one of those is centralized. And, I don't see the problem with that. There's a lot of kind of hate from the DeFi community, amongst these centralized entities, but I do believe they still can offer great yields at arguably a better risk reward level than some of these DeFi protocols, albeit they'll pay a lesser reward. So my TLDR on this entire video is I think the Ethereum merge will be bullish for the Ethereum price long term. I think that's no secret at this point. The discounted cash flow model suggests that Ethereum could hit $6,000 to $9,000 post merge. Now this could take some time because obviously this market we're still in a bear market, so it's unrealistic to expect crazy multiples from any token, irrespective of the models. However, it does give me confidence that the ETH valuation is probably trading closer to fair value than previously suggested. And at the same time, the rewards, the indication of the staking rewards, the 10 to 11% yield, in tandem with the decreased issuance, that's going to be bullish for the Ethereum price as well, because higher yields incentivize staking, and higher decreased issuance also reduces the amount of supply coming onto the market. So we're kind of seeing this, double-edged sword effect from Ethereum. All of these will result in higher network activity post-merge, which obviously results in higher fee generation. So it's a little bit of a flywheel effect, amongst Ethereum price action. So that's why I think the merge could potentially be bullish for Ethereum. And, that's why it's, one of the tokens that I'm still DCAing into, regardless of the market. So make sure you smash the like button and subscribe if you're watching the show. Smash the likes to show some love for the strategies I gave you guys today. And also, I see a few questions there. I want to answer some of your questions live. So I'm going to go over to my Twitter. I know a lot of you already follow me on Twitter, but if you're not, there's a link in the description. It's at Miles Deutscher. And you can follow me on Twitter, and I'm going to be going live, doing a live Q&A on my Twitter. I don't really do these very often. So if you want to jump on Twitter, ask any questions you may have regarding whatever I said in today's show, or, my opinions on protocols and crypto in general, then yeah, let's have a conversation on Twitter right now, in the form of a live Q&A. So I'll see you over on my Twitter. Hope you guys enjoyed the show. Hope you have a lovely day. Peace out.